Hello and welcome to AGN 3613. In this session we will continue evaluating projects and investments using present worth analysis. Then we will address future worth criterion. In addition, we will go over Excel Analyzer and the graphical tool within Analyzer that will assist in decision making. And last, we will discuss capitalized equivalent worth. From last session, the initial calculations of the present worth was using cash flows to determine the payback period and was not considering time value of money. And then, at a certain point, we used the discounted cash flow calculations or techniques, which included the time value of money. We also learned that if we have present values for inflows and outflows, then we need to find the total present worth, or what we call the net present worth or net present value. The net present worth is the difference between the present value of the inflows and the present value of the outflows. The net present value will help us decide if the investment is acceptable or not. The steps that we need to follow to evaluate a single project is as follows. First, we need to determine the minimum attractive rate of return, or what we refer to as MARR. In the previous session, we addressed the concern of any investor, which is the main question that they ask: when can I get my money back and start making a profit? So the payback point, the point that you pay back everything and you start making the money, that's what we call the minimum attractive rate of return, or MARR. Once we define that, now we move to the second step, which we estimate the service life of the project. What will be the service life of the project? And in the third and fourth steps, we estimate the cash flows, or we find the cash flows, inflows and outflows for each period during the project life. In the fifth step, we determine the net cash flow for each period. For example, what was gained minus the maintenance. In the sixth step, we find the present worth for each cash flow at the MARR rate, or the minimum attractive rate. And the sum of periods present worth is defined as the present worth of the project, or net present worth for the project. In the last step, we judge the project. If the net present worth is positive, then the project is accepted, or it's a go, while if negative, the project or the investment should be rejected. So the main concept or principle is to calculate the net present worth or net present value at n equal to 0 with a given interest I, and then we take the proper decision, which is accept the project if the net surplus is positive and reject if it's negative. What if we have more than one project or alternative? We will follow the same steps in finding the net present worth for both alternatives or all alternatives, and select the investment or the project with the highest net present worth. So it's the same steps, the same thing that we are going to do, or that we did before, but we are comparing two projects or two alternatives. If it's positive, one positive, one negative, then we choose the positive. If both positive, we choose the highest. If the alternatives are based on cost and not profit, then we choose the alternative with the minimum cost. In this example, we have a company that needs to buy a new machine with $75,000, assuming that they will gain $24,400 the first year, $27,340 the second year, and $55,760 the third year. So if the money invested at zero is not back within the next 3 years, they will reject buying a new machine. We need to help the company make a decision, assuming that the interest rate is 15%. If we find the present worth for the cash inflows, so taking the 24,400 to 0 and the 27,340 to year 0 and the $55,760 to year 0, we find the present worth of the inflows at 15%, which is in this case, after the calculation, it will be $78,553. Now remember that we bought the machine with $75,000, and that's the outflows. So calculating that, we have present worth 1, present worth 2, we subtract, and we get $3,553. Now this value is greater than 0, which is positive. Since this is positive, then we accept the project. And this is the whole idea from bringing everything to point 0, where I can compare both values and see if it's worth investment or not. If it's not worth, it does not worth investment, then I will not invest in this project or in this machine. We can also use Excel to find the net present value and make the judgment based on the results. And all what we need is to put the values in, as you can see here, and put the formula, which is net present value with 15% and the range of the input or outflows and inflows. So we have the inflow, the gain from 1 to 3, or from B3 to B5, and we have the outflow or the payout of pocket, which is B2. So if we take the net present value for these values, we will get $3,553.46. Now remember that this is more accurate because of the 2 digits that I added after the period here, but in our example, actually we were not taking the cents into consideration, but it's the same. So don't worry about the the small difference that you will get at the end here. You will get that most of the time between whatever maybe in the book as an answer and whatever you answered. This is a valid change or difference, but the most important thing is the value of the big numbers to be the same. Since the big numbers are the same, then you're fine. We can also find the payback point through creating a graph representing interest versus present worth or present value. And as you can see in the graph, the break-even point interest here is 17.45%. and this is the minimum acceptable rate, which is MARR. So you can below this point you can accept, and above this point you can reject the projects. The table also is showing the different calculations for present worth at each interest rate, starting from 0 here, and we are increasing the interest until we reach to 17.45, and that's when you got present worth of 0. That's when you break even, and then you start going into negative if it was above, and that's why we reject the project. So below that it's positive, so we accept, and above that value it's in negative. All these values are in negative, that's why we reject. A very good question at this point will be, what factors should the company consider in selecting good MARR in project evaluation? How can I select the proper MARR? There are three factors need to be considered. First, the risk on the return. Second, the inflation factor. And third, the risk premiums. For example, if you invested in the US Treasury bills, that is considered a risk-free return, which will be, in this case, with a very low interest, for example, about 2%. Although no risk premium associated with the US Treasury bills investment, we need to consider the inflation rate. If I'm dealing with interest rate or with the internet stocks, then the risk premium will be high, and still, I need to include the inflation. Usually some of the risk can be 20%, some of them can be even higher, and you can see here the interest now became about 26%, and that's very high. This figure shows a comparison between the US Treasury bills and the Amazon.com stock market, including the inflation and the risk premium factors, and you can see it jumped from 6% to 26%. It's very risky, but the gain, if there is a gain, this will be more than this one, but if there is a loss, of course this will be bad. Using the stocks for Amazon and losing money, you lose a huge amount or bigger amount than the risk-free US Treasury bills. To understand the real concept of the present worth, we will introduce two concepts. The investment pool concept, which is defined as the firm's treasury or pile of funds, the money that you save on the side to use. If that money was not used for investment, then you will earn at least the MARR in that saving or in that pool. The second concept is the project balance. The project balance, which tracks the project money, assuming that it has been borrowed with interest I, and to get the return on that investment. Again, with the investment pool concept, the company has two options: either to take the money out and invest in a project, or leave the money in the company in that pool and gain whatever interest on that when they keep them there. We can look at the two options and see the consequences for each option. If we go back to the Tiger Machine Tool Company who wanted to look at the option of buying a machine of for $75,000. The example that we just did. If they use that money from the money pool and they would like to invest in the new machine, we would like to see what's going to happen, or what are the consequences. And at the same time, if they left the money in the pool for 3 years, what are the consequences, and see if we can assist the company in making the proper decision. So buying the machine will return, as we said before, $24,400 for the first year, and it will return $27,340 for the second year, and $55,760 for the third year. Now, bringing all these to the future, or moving all these to the future, we can find what will be the value in the future. Finding the value of the future for each one of these values, since I'm moving everything to year 3, then it will be 0 for the 55,760. It will be 1 for the 27,340. It will be 2 for the 24,400. So the future value will equal the sum of these values, and that will equal to $119,470. That will be the future value for all these payment or returns. Now, how much would it be if that investment or that money was left in the account for 3 years? If I have that 75 here, 75,000 not taken out, 75,000, we did not take it out, and we left it in the account, and we would like to find the investment, or how much would it be in the future, moving it to year 3 with 15%. And actually, I should do it the other way around, because I did not use it. I just kept it in the account, so I can erase this side, and it's up there. So the 75,000 is going to be moved to the future with n equal to 3. If n equal to 3, the interest is 15%. We are giving the present value of 75. The future value will equal to $114,066. So this is the value if I left the money in the account. This is the value if I invested and bought a new machine. So what's the net gain from the investment? The net gain is the difference, which is 5,404. And again, this is 5,000. It's F1 minus F2 to see the difference between the two options. And we will decide that, actually investing and buying a new machine is a better option than just leaving the money in the account, because I will gain $5,000 more. And if you bring that $5,000 to the present value, to find the present worth of that. Present worth at 15%, it will equal to $3,553, which means it's positive, and that is confirmation to accept the project. And this is just a confirmation to the change of cash flow, where we send the money to the future, compare the two options, and decide if I want to invest or not. Like we said, based on the future worth that I got, or if I move that to the present worth, since it's greater than the 0, then I will accept the project. And we can do it in Excel as we did with the same question before. All what I need to do in this case is to add to my Excel sheet, since I have the present worth already being calculated, just add the future worth with the future value. We have 15%, 3 periods, 0 type 0, and we are moving the value of B6 to the future, or you can calculate the values, these values, move them to the future. One of the tools that's available online to calculate these values for you is the cash flow analyzer, and this is the website or the link for that, so you can just copy paste the website or the link. Let's see. And you'll get the analyzer. So this analyzer actually will assist in getting the values that we need. All what we need to do is to put the negative 75,000, the 24,400, the gain for the first year, and then 27. I need to remember the numbers. 27,340 and 55,760, and I can add the 15% and say compute, and I got the 3,553 and 46 cents, which is the present worth or net present worth. So this is a way to do it using the analyzer, and this is just a tool that's been created to make it easy for you. Instead of adding all these formulas to Excel sheet, this already being created. The best about this one that you can select the period for the future, and it will calculate also the future worth for you if you want. It can calculate the annual worth if needed, and then at the end you can even do diagram to judge what to do. So you can use the present worth and say plot, and it will give you the plot for the present worth, and this is the point where you reject, because this one in negative, it's down under, and this is positive, so you accept as long as the interest is below this, and you reject as long as the interest is above this point, and this is the point which is the 17.74 that we talked about before. And I'll keep this open because I will reuse it again in few. Um, the project balance concept. Again, we have to monitor the project during the execution and see if the balance is correct. This is a very important thing to do, especially when you are the project manager or you are responsible for the project, and you need to make sure that you are earning what being promised over the years to pay back the initial invested amount. So the initial invested amount was 75,000, and that's at point zero. We bought the machine. Now, since I bought the machine, I have interest of 15% on the 75, so I have additional 11,250 that I need to add. I gained 24,400. So I need first to find the total for these two, then add the 24. Those are negative because these being used out of pocket. This is positive. This is what I gained, and the sum or the result will be still in negative because I didn't pay back the whole amount, or I didn't gain that much. I didn't gain that much to pay all the amount. In the second year, I got 27,340, but I have still interest on the remaining amount, which is 61,850. Based on that, I will add both these values, then add the positive value of 27,340, and I will get still a negative value. So I still owe the bank or my pool the money that's been invested. Still, I did not make positive money. I didn't make any money yet. In the third year, the interest now is lower. Add that to what's remaining, the remaining balance, and then add the gain, which is 55,760. And at this point now, in the third year, or it could be like 2.4 or 2.3, we can see that now. I will show you in the analyzer. At this point, we started making money, and now we are in positive. So the net present worth now is in positive, and I can I mean, this is the future worth. The future worth will be positive. That's 5,404. That's the future worth, and then I can bring that to the present worth, and that will be also positive. That's when I say, okay, now I will accept the project. Since the third year now I'm making money, then it will be approved for execution. This is a chart that will show you the project balance diagram, and you can see that the balance was getting less and less, which is the money that we need to pay back, until we started gaining money at a certain point. At that point, that is when I broke even and started to gain, and we call that the discounted payback period. I can use actually the analyzer to show me that, and I can say show me project balance plot, and it will show me how I broke even at this point, and then I went up, and that was during the third year. Actually, if we would like to make sure when did I pay it back, then if it's conventional, then it will be at 2.41, while if it's discounted and I took the value time value of money, then it will be 2.9. That's when I broke even and started to make positive money. Also, I can make cash flow diagram using this one, and that will show me exactly the payments, the 75,000, the 24,400, the 27, and the 55. So this one shows the inflows and outflows for the cash flow. This is a very beneficial tool that you can use and you can utilize to calculate for you the present worth, the future worth, plot diagram, and assist you in taking the decision to go forward with the investment or not. It's more of a visual tool that will assist in making that decision instead of doing all the calculation or even creating your own Excel sheet. It's there and it can be used to analyze the present worth. Another concept that we need to look at is the capitalized equivalent worth, which is a special case of the present worth that is used when the life of the proposed project is perpetual or the planning horizon is long. If it's more than a certain number of years, for example 40 years or more, then we can consider that as capitalized equivalent worth and not present worth. It's longer than that, so that's why it's being called capitalized. Do we have situation like that or projects like that? Yes, we have a lot like that, like dams or bridges. They are considered as capitalized equivalent worth projects. The process of computing the present worth for this infinite series is referred to as the capitalized or capitalization of project cost, and the project cost will be known as the capitalized cost. So the capitalized cost, to be more specific, represents the amount of money that must be invested today in order to yield a certain return at the end of each and every period forever, assuming interest rate I. So I'm looking at the annuity that will result from this investment over the years with interest rate, certain interest rate I. The principle is to calculate the present worth with annuity A over infinite series life, and that's based on the equation which we used before, present worth, but in this case we are going to call it capitalized equivalent, or CE, with I interest, and that will equal to the annuity that will be over the years multiplied by P given A with interest I, and the number of periods is infinite. The number of periods is infinite. How do we calculate that? We don't have that in the tables in the back. We don't have infinite number of period. Instead of that, actually we can just divide A by I, by the interest, and that will be our present worth, or what we call capitalized equivalent. For example, if we have I equal to 10%, n equal to infinity here, the interest rate is 10%, and we need to find the capitalized equivalents with 10%, and those are the annuities that I'm getting. Notice that after the 10th year we started to get 2,000 annual. So how can we calculate that? Remember that when I have such a problem, I can break it into two pieces. The first 1,000 goes all the way to infinity, so I can break these into 1000 and 1000. And for this, then I can use 1000 over the interest rate, which is 10%, and I'm done with the first 1000. Now how about the second 1000 that we left over here? So this is the first 1000 and I'm done with that. Now we're done with this because we used this formula to represent these annuities. Now how about the second 1000 that's over here? Although this goes to infinity, but it goes back here, and then I need to take it back to the present worth 10 years. So I will calculate the value for this infinity, and then I will take it back 10 years with 10%. I will consider this as future value. So we find it here as future value. And I took the future value to the present, so I'm calculating the present value given F with 10% and 10 periods for this amount. The result will be $13,855. Let's look at another example. In this example, we have a bridge construction project that will cost $2 million. After the bridge being built, now already being constructed, now I have maintenance, and the annual maintenance for this bridge will be $50,000. Every 15 years, after we build the bridge, it needs renovation. So every 15 years, we need to renovate, and the renovation cost at that point will be $500,000. That bridge will stay there for infinite period. Based on that, I need to calculate the present worth for this project with interest rate 5%. If we look at the cash flow diagram, we can see that we have the annuity of 50,000 that will be for infinity or infinite series, infinite period, and I have the 500,000 renovation every 15 years. And of course, I have the initial cost of construction. So we have P1, P2, and P3 that represents the 500. This is P1, and then all these annuities need to be returned back to 0 as P2, and then all these payments, renovation cost, should be also returned back to 0.0 as P3, and the present worth, or in this case the capitalized equivalence, will equal to the sum of P1, P2, and P3. So P1 is 2 million, P2 is 50,000 over 5%, just A over I, because infinite, and that will equal to million. And then we need to calculate or bring the values of the 500,000 to the present, which is every 15 years. So we have to bring the 15, the 30, 45, 60, and so on. Or we can use the initial value and consider that as infinite series and divide by 0.05, which will bring the value to $4,663,423. Adding these, the 2 million, 1 million, and the 400,000, we get $3,463,423, and that will be the total present worth, or the capitalized equivalence for this project. We can also use the effective interest rate per payment period, the one that we learned before, and as you can see here, we can calculate I effective using the formula, which will be 107.893%, and then use that to calculate P3 by dividing 500,000 divided by the interest I, and that will give me the same value. Another example, a company want to purchase an electrical motor rated at 15 horsepower for $1,000. The service life of the motor is known to be 10 years with negligible salvage value. Its full load efficiency is 85%. The cost of energy is $0.08 dollars per kilowatt hours. The intended use of the motor is 4,000 hours per year. Find the total cost of owning and operating the motor at 10% interest. To solve this problem, first we need to convert the horsepower to kilowatt, and we know that 1 horsepower is equal to 0.7457 kilowatts. Since I have 15 horsepower, then the 15 horsepower will be multiplied by 0.7457, and that will equal to 11.1855 kilowatts. So now I have the kilowatts for the machine, but the machine is not it will not be working with a 100% efficiency. It's actually working with 85% efficiency, which means that there will be extra consumption because of that. So the actual consumption is not 11, it's 13.1594 kilowatts. So the required total kilowatt per year, since it will be operating for 4,000 hours per year, then the total will be 13.1594 multiplied by the 4,000, and that will give me a total of 52,638 kilowatt per hour, kilowatt hours per year. Now we got the kilowatt hours per year. How much will be the cost? The cost of each one kilowatt hour is 0.08 dollars. So we multiply by the 52,638 and we get $4,211 per year. So this is the amount of dollars spent on the machine, operating the machine for a whole year. If the cost of that machine is 1,000 and the operating or the power needed is 4,211 over 10 years, we calculate that amount, and that will equal to $26,875. This is the present worth of buying and operating this machine for 10 years. And this slide shows a cash flow diagram that represents the cost of buying and operating that motor, and we can see that every year the cost will be $4,211, and we brought these payments or annuities to year 0 or 2.0 with 10 periods 10%. At year 0 we have 1,000 cost. We add the cost of 1,000 plus the expenses of operating it, and that will be 26,875. That will be all for this session. If you have any questions, you can email it to me. Thank you and have a great day.